Alright, so Sam, I've already worked out most of these except for a couple. Yeah, except for one actually, the only one that I can't work out. I'll try and get back to you tomorrow on it because, to be honest, it's a bit late and I can't really think. I'm pretty tired, to be honest. So, number one. So, when you're talking about management information, so management accounting, as we know, for number one is it's always internal information. It's never checked by anything. It's just checked by your managers. Yeah, it's not. You don't require it by legislation or anything like that. It's just how well the company's run, depending on what management information they want or anything like that. So it's not. It's never produced for external parties. So number one is wrong, and there's never a legal requirement for it. The true thing is there's no strict rules, as I was saying, to governing it, and it may be presented in monetary or non-monetary terms, as you know, through how would I put it, the balance scorecard, because you can have management information that's put as part of the balance scorecard. So number one is A, which is 3 and 4. The purpose of situational analysis or strategic analysis, you should know this through the work that you were doing, the one that you sent me, but then you wanted to do yourself, which is regards to like the SWOT analysis, the private equity firm. So that's the situational analysis is looking at where you are at the moment in time, and it's an assessing the internal and external environment of the organization. So evaluate the strategies available to the organization is not situational analysis. Selecting the most appropriate strategy is also not that, and establishing the long-term direction is also not it, because they're all too similar. So when you're looking at situational analysis, you're looking at your internal analysis, you're looking at where you are right now, and you're looking at what you're good at and the external environment, and you're looking at both of those things to decide what you can do in the current situation. So number two is B, and a lagging performance indicator. So something that's lagging is it tells you after the fact. So a lagging performance indicator is delayed reporting of performance. Yeah. Something that's like, for example, C, an indicator that depends on another performance measure, would probably be called a contingent one. An indicator that highlights past performance is not that, and an indicator that can anticipate is also not that. So, okay, number 4, what you need to do, this is basically just the high-low method. So you're basically trying to work out the difference. So instead of looking at these as percentages, just look at them as full numbers. So we've got 75 and we've got 50. So what we do here in your calculator, just make sure this is recording here. So you would do equals 112,500 minus 100. You get 1,250, 500, yeah? Then you would do 75 minus 50, 25, divide that by that. And per unit difference, it's 500. And so we know per unit difference because it's 25% difference between these two. So the per unit, so the difference between, so we know that it's going up every unit, it's going up 500. So it gets to 1,200 from 100,000. It gets to 1,200. To 112,500. So we want to know where it would be at 80%. So that's 5% more or 5 more than 80%. So we would just times that by, well, I mean, you can do 80 minus 75, which is 5, times that, yeah, 2,500. And we already know at 75%, it is 112,500 plus that, so plus 2,500, which is 1,500, so it's A. So here, what they're asking you is they're basically asking you what your residual income. So your residual income is basically, when you're looking at residual income, it's just like, my cost of capital is 8%. I've got assets of 1 million in this. I should produce at least based on my cost of capital to return my cost of capital, so my cost of borrowing, whether it's from equity or debt holders, is 8%. Therefore, to break even on my assets, I need to return revenue of 8% of 1 million. So if we go to division A, because my assets are 1 million, division B and my assets are 1 million. So I would say what I would expect on a basic level, if I'm doing a reasonable business, like I would expect to produce normal profit, which is div A, and div B. So both of them are 1 million, yeah? Yeah. So that's my asset. So what I would say then is based on that, and my cost of capital is 8%, yeah, in both of them. So basically what I should expected profit should be, expected return would be 80,000 in each, yeah. Okay. Okay, that's one. Okay. 80,000 in each, yeah. My actual profit, as we can see, is 500,000. And then 300,000. So what you do is you say your residual income is the difference between what you actually returned and what you're expected to. So we do your residual income, which is that. You say, I actually returned that and I was expected to return that. So the additional above what I was expecting to return is 420. 200,000 is 220. So the residual income is higher in division A than division B. So it's C. So, and this number 6, products might consume overhead in different proportions due to difference in product size, difference in product complexity, and different in product setup times. It's all the above, as we know. Number 7, I will get back to you because it wasn't clear to me. Like I did a few different things here, but I didn't get the right answer. I'll speak to you about that in the morning. The following statements relate to advantages that linear regression has over. So this is just a case of you learning a linear regression, but linear regression takes into account of all the data points, and it assumes that cost behavior is linear. So it's one, but which statements are true? So what you want to take has over the high-low method. So the high-low method doesn't take into account all of the data, but it does assume a linear cost behavior. However, it can't be statistically tested because it's not a statistical method. So it's 1 and 2 because it does a high-low method does assume a linear relationship, but it doesn't do these two because it can't, because it's basic. So sales volume. Okay, so sales volume. So here, this is a trick question, right? So you've got to be careful because at sales volume of 25,000, businesses' total fixed costs are 40,000 and total variable costs are 55,000. The relevant range. So the relevant range here is referring to specifically fixed costs, yeah, because variable costs will vary because they change based on how many units you produce. So your variable costs will always increase, but your fixed costs in here will not increase. So the key thing here is if the business was to sell 28,000 units, this will not change. This will stay the same. So fixed costs will stay the same in this unit range, and that's what they're saying. So what we do, we automatically go to in your calculator or whatever, or if you're writing it down, fixed costs, we would say 40,000 because we know that. Then we will work out our variable costs per unit. Which would be, in this case, 55,000 because that's what's been produced at this stage, divided by 25,000. You wouldn't do the 28, so you would do 55 divided by 25,000. Yep. 2.2. Then you would do VC, variable cost, because you know it's 2.2. You would take 2.2 and then times it by the 28,000. Voila. And your total cost then would be 101, so it would be D, yeah? So which price strategy is likely to set a high price is price skimming. A price skimming is a strategy because it's like buying a new iPhone. When the new iPhone comes out, it's set very high, so it could take advantage of those people that really want it regardless of the price. So it's price inelastic, so it would be B. It's price skimming. Penetration strategy sets it low to take advantage of price elasticity. And they are your multiple choice answers, and I worked them out beforehand, so all good.